If you want awesome products at great prices, check out the in the description. Roche's $50 billion U.S. investment, a preemptive strike against Trump tariffs. In a bold move that could reshape the pharmaceutical landscape, Swiss pharmaceutical giant Roche has announced a staggering $50 billion investment in U.S. manufacturing over the next 5 years. This monumental commitment, expected to create over 12,000 new jobs, comes as the industry braces for the potential impact of President Trump's threatened tariffs. The announcement feels less like a benevolent act of corporate social responsibility and more like a strategic preemptive strike. It follows President Trump's initiation of a 21-day investigation under the Trade Expansion Act, a move widely interpreted as a prelude to imposing significant tariffs specifically targeting the pharmaceutical sector. This investigation, announced just last week, has sent shockwaves through the industry, prompting a flurry of similar investment announcements from companies seeking to mitigate the potential financial fallout. The pharmaceutical industry, already facing intense scrutiny over drug pricing, now finds itself navigating a complex geopolitical minefield. European pharmaceutical leaders have voiced dire warnings of a potential investment exodus from Europe should Trump's tariffs materialize. Roche's massive investment can be viewed as a direct response to these concerns, a strategic attempt to solidify its position within the U.S. market and potentially avoid the brunt of any impending tariffs. This isn't simply about avoiding tariffs. It's a calculated gamble on the future of the U.S. pharmaceutical market. The investment promises to significantly boost U.S. manufacturing capacity, potentially creating a ripple effect throughout the economy. The 12,000-plus new jobs represent a substantial contribution to the U.S. workforce, a factor that could influence the administration's decision-making process regarding tariffs. The sheer scale of the investment underscores the significant stakes involved. However, the success of this strategy remains uncertain. While the investment undoubtedly demonstrates Roche's commitment to the U.S. market, there's no guarantee it will completely shield the company from potential tariffs. The Trump administration's unpredictable trade policies make it difficult to predict the outcome. The investment could be viewed as a strategic concession, a way to appease the administration while simultaneously strengthening Roche's position in a crucial market. This situation highlights the delicate balancing act pharmaceutical companies are forced to perform in the current political climate. Navigating the complex interplay between geopolitical tensions, domestic economic pressures, and the inherent complexities of the pharmaceutical industry requires a keen understanding of risk management and strategic foresight. Roche's bold move serves as a compelling case study in proactive risk mitigation, but only time will tell if its $50 billion gamble pays off. The industry watches with bated breath, waiting to see if this massive investment will be enough to deter the looming threat of Trump's tariffs. The coming weeks and months will be crucial in determining the ultimate impact of this significant investment and the future trajectory of the U.S. pharmaceutical industry.